Welcome everybody. Let me just take that text off. Right, so interesting times. So the big question in everybody's mind is, where are we now? So let's just grab a look at, I just wanted to sort of take you back a few steps first and then wind you into where we are. So I thought this is the daily Dow at the moment. So this is the general way in which the market dropped and then capitulated. So we had some bad news coming here, particularly more on the UK side than the US, but we were basically just very extended up here. And on the end of the second week in Feb, I sent a screenshot out to everybody in my alert room, and I said on that second Friday in February, I can't remember the exact date now, I think it must have been about the 14th, I said expect a pullback. I showed them showed a daily chart of the DAX with a huge divergence, and we'll talk about divergences in a minute. But on the the 14th of Feb, I said watch out for a big pullback. I didn't say watch out for a huge drop or a crash. I just said these markets are too extended and in much need of a pullback. So here we had, the bad news was coming out. We knew China was in trouble. Wuhan was closing down, and eventually in the early part of Feb we dropped. Then we had some profit taking, a degree of acceptance and a lull in the appreciation of what we were actually facing. And then death toll started to rise, problems started to kick in, and then we saw the second wave down, a little bit of profit taking, and then the capitulation down. Now these are months. I'll talk about why we turned around on that, on how you can find these bottoms, or potential reversal points, I should say. And in the meantime, where are we now? So we just, this is the point in which we started getting all the major lockdowns in UK, US, etc., and other parts of Europe started to lock down. So the markets took that as the beginning of the end, and started to find some some bargains are out there, and they got snapped up. And we'll look at how you can find those and work those through. In the meantime, so we had a 1, 2, 3 wave back to the upside. Now, why have I said that's the mean average? That's the key. So this is where we close on Friday. Why have I said that's the mean average? I'll show you in just a moment. So the other questions I'm going to address here in the initial intro is, the first question I just posed, why am I calling it a mean average, number one. Number two, the key question is, we are in recession. We've got US GDP coming out in this, I think it's Wednesday or Thursday this week. It's a demand shock. We know for sure that we're in a recession. The question is, how do you handle a recession, and how long do recessions normally last? This is different. This is, I was going to say it's a one-off. I mean, you can hardly call it a one-off given what happened in 1918. But it's, as far as you and I are concerned, it's a one-off and a completely new experience, because none of us have lived through this before. And so we've seen some extreme moves under extreme situations. So what I want to talk to you about today is where I think we are now and how long you can expect to see these markets under these key moving averages, and therefore still in a bear market. Anybody got any questions? Far away. Everyone 99 years, yeah. I just realised I haven't got my earphones on. That's really remiss of me. So let me just do a quick intro, and anybody who wants to actually physically ask a question, turn on their mic, then I'll flick the switch on that one, and then you can ask as much as you like. But let's just, okay, initial intro, let's get this over and done with. Okay, so this is now let's just talk in pure technical terms for a moment, because I've done this particular slide format for those of you who may not be as technical as others. But let's just switch to pure technicals for a moment and have a look at this. So this is wave one. I'm an Elliott wave fan, so Elliott wave is really, really important to our trade, and I believe it's the code of trading, and this can help you trace and predict the next moves. So wave one, wave two, retracement after some profit taking. Now in Elliott wave, I think it's Robert Elliott in the 1930s, he became gravely ill, and instead of just rolling over and, well, I was going to say watch telly, do that much of watching television in the 1930s. Anyway, he decided to do this incredible study of patterns in the market and came up with this wave pattern, which you can lay over any good volatile liquid markets. Not every market, not every chart, not every stock, but most liquid volatile markets. So this was the initial, that's the initial move, that's the pullback, and then this is where everybody else joins in. All of those traders who missed that move are measuring that pullback, and that's measurable. There's a key level up there, and then that took you to this wave to the downside. So that's wave three. Wave three is normally the biggest. Wave four is the pullback, and wave five is the completion. So that's the completion of a 5-wave move. Anybody who doesn't understand Elliott wave and really wants to really master trading, you do need to study Elliott wave, in my opinion, that is, and in many professional traders' opinion. Okay, after a 5-wave move, then you normally get a 3-wave retracement. So then we've got a 1, 2, 3-wave retracement at this point. And then I've used the term mean average. So at the moment, having had the 3-wave retracement, we've got a very, very shallow leg to the downside here and a pretty pathetic move to the upside. Right, let's come away from this graphic and let's look at some specifics. I'll just call that off. Right, this is a weekly chart of the Dow. I'll just go to the daily first. So, if you are trading stocks, some of you might be day traders, pure day traders. Some of you might be investors. Wherever it is the case, you still need to know, this is one of the things you need to know when you are coming in and out of the markets. You need to know where these general indices, in this case the industrial Dow Jones index, you need to know where these are heading, because these are a very select number of stocks, and so therefore this index is showing you the general mood, the general condition of the market. So the reason why I'm talking to you in terms of this being the mean average, because if you throw on the Fibonacci, you will note that on Friday, this dotted line is the 50%. Now, typical of markets love to come back to the mean average, standard deviation. Hence the reason why Bollinger Bands can work, because they are calculating standard deviation, and they are one of the many, many tools out there that will help you find where these markets might be wanting to land. Okay, so the other thing to notice is a couple of basics on the technical front. We are highish on, we have been very highish on the basic stochastic. This is a default stochastic, there's no other, I haven't sped this up or anything like that, I haven't tweaked it or adapted it. And you can see the volume levels down here. So we all need to know the degree of commitment and volume in each of these moves. So you see we came down on an increase in volume, so that's a commitment to the move. We saw some profit taking, and some lower levels of volume as we recovered, and then we started to see some increase in the red bars on the way down again. So at the moment we are, like I said, we're at a pretty sort of average point here, having had the demand shock. It's, you know, an exceptional demand shock, as we all know full well, and then we've seen this recovery in the US. Let's just have a quick comparison with the UK in relation to that. You can see, whereas the, let me just update this. Let's just see if the UK has done a 50% retracement in line with what the US has done. So the UK already had very weak GDP numbers. We only marginally avoid a recession before this anyway. So you can see a direct comparison between the FTSE 100 and the Dow Jones 30 index. The Dow has done a complete 50% retracement. This has barely done, this is about 35%, roughly, give or take a few pips, a few percent. So you can see the UK is really under the cosh. Why is that? I think essentially we've seen, well, the US, for a start, the US came into this in a much better shape than the UK did in the first place. That's number one. Number two, I think the commitment from the Fed and the state has been swifter and more generous than the UK, and therefore, just generally the US are more, should we say, adventurous and entrepreneurial when it comes to swift moves like this. But I mean, in terms of pure fundamentals, the UK came into this in a lot worse shape in the first place, in terms of our sovereign balance sheet and the actual state of the economy in the first place, before all this triggered anyway. Okay, so yeah, of course, Brexit at the moment has cost, I can't remember the figures now, I think, is it 3.5 billion? That doesn't sound enough, actually. Anyway, doesn't matter. The point is that the UK is under much severe stress than the US, and that is shown in the much feebler, weaker bounce that we've had in these markets that we've had in the US. Okay, so
Mike, can I ask a question, please?
Yeah, go on.
So surely isn't there a thing that the FTSE is likely to come up to the average point? Isn't that a possibility?
Because it's lagging the US, and because
on the
you would expect that to...
no, on the fibs, you're saying that markets like to come back to the 50% level, so wouldn't
that's one level. Well, the main reason for calling up the FTSE in relation to the Dow was just to show the inadequate bounce that the FTSE's made. I mean, in terms of a selling point, let's go back to the Dow for a second, and then I'll answer that question. Yeah, there's two, in terms of the next leg down, if we are going to get another leg down, which is what I'm anticipating, I would normally expect a move into the 61%, or at least at the minimum 50%, normally 61%. So at the moment, the Dow has breached the 50%, immediately fell back, which is bearish, and then closed in a neutral position on Friday. I mean, the fact that the FTSE hasn't retraced as high, to me, doesn't mean, I wouldn't sit here and expect the FTSE to continue higher purely on that basis. It could mean that we've got the fact it can't even reach the 30%. If we then subsequently get sell signals, which we haven't got, or particularly in the Dow at the moment, and in the daily in the FTSE, if we subsequently get sell signals from here, then the likelihood is that we could potentially breach these lows. at some stage. So in answer to your sort of main question, I'm not, I wouldn't sit here and expect 62.30 to go and be hit, unless we start to close above 58.70. Quite the contrary, if we
But
are,
is this also not to do with the state of lockdown? That I mean, that's got to be a big thing. That in the States, there's a lot of people coming off lockdown already, and in the UK, we're already we haven't got any idea of when we're going to come off.
yeah, you've got President Bush, President Trump pushing a lot harder, and as you say, some states already opening up. So
you know, if they announce tomorrow, okay, in 2 weeks' time that the lockdown is beginning to end, surely that's going to have an upward effect on the FTSE, and it will move towards that 50 or not.
that's the problem with these markets at the moment is there's too many variables.
Uh-huh.
You know, it doesn't, you know, both sides of the Atlantic. It doesn't matter what market you're looking at, Asian, Europe, US. There's, at the moment, there's too many variables, and as Howard said, yeah, we're right in the early stage of. We're still in mid-stage earnings session in the US as well, and yeah, the FANGs are reporting this week. So all of those factors are creating this sort of balanced market at the moment. All we did on Friday was just complete this sort of balance. You can see I've just drawn a little apex there at the moment, and you know that shows a sort of indecision that we've got in this market. Now, whichever way we come out of that apex could propel us one way or the other. And I think you're right. I mean, I actually spoke to a doctor a few hours ago today, and she's in the UK. And she said that some of her colleagues, you know, the hospitals are getting so quiet, some of her colleagues have been sent home.
Yeah.
And she doesn't think she's going to be asked to do any additional hours. So, and the German schools are going back. I think it's the first or second week in May. And obviously, Germany have handled this a heck of a lot better than the UK. And so there are, yeah, as you say, if we see some early stages of lockdown being lifted, and that is getting increasingly likely, and hence the reason, and the market's pricing that in. This bounce is pricing in a lifting of restrictions. So yeah, whichever way we can, if we start closing higher in, you know, the first half of this coming week, or at some stage during this week, then that could see, particularly if we close above 58.82, that's the big signal. So these are numbers to watch for. One of the things that I want to sort of get out of this today is just have specific numbers to watch for, so that we can tell whether or not we should be coming back into this market. But and likewise, any close lower than that would get me particularly bearish. So what I'm looking for, I mean, in terms of this, it's a hell of a demand shock that's taken us to extreme levels and typical overreaction, given that we've got algorithmic based markets now, not hedge funds and stockbrokers sitting there making decisions. We are driven by what computers are triggering in large part, but nonetheless, you know, human behavior and of course charting can help us predict what to expect at this stage. So what I'm looking at is, there's several things I would take from this chart, and several things I'm going to talk to you about in terms of assumptions and scenarios in the next sort of 10, 15 plus minutes. Is on the pure technical levels, obviously we need to look at how we come out of here. On in terms of what I would expect to happen in terms of, sorry, I lost my thread momentarily.
Sorry, what you're basically saying is if we close above 58.82, then it's a good time to get into the FTSE because it's likely to.
Yeah, I think, yeah.
Is that right?
I think I've just found my thread now. Okay, I'm back on track now. So I think with a severe demand slump and an overreaction, overall, I think very short to medium term, I think we will see a push higher. I think there's a lot of evidence coming through from various economies and regions that we are already going to see some lifting in the coming days and the next couple of weeks. UK seems to handle this a lot less effectively than certainly other parts of Europe and so on. So it could be the UK is going to lag in terms of lifting limits, which is perhaps one of the many reasons why this FTSE has been lagging. But so I think we've got some gaps up here. So the other thing I'm looking for is just as we had an overreaction of the downside, we could well see an overreaction of the upside. And then at some stage in the coming weeks, as we hit these resistance levels, then it could be a good opportunity to get short. The main crux of this at the moment is if you are an investor, if you're looking to get the most out of your savings and your pot of money, I think you should be at the very least risking some of your capital in a measured way on certain good quality stocks. I think at the moment the key to any trading at the moment is quality. So if we then apply that to some of these sectors that we've got at the moment, let me just clear this drawing. So stocks like, just coming down to this list here. Stocks like Goldman Sachs. Goldman Sachs are obviously a premium organization in the investment market. If these guys are going to hold up, then that's one of the many bellwethers, one of the many measures that you could take from this market and risk a proportion of your capital on the potential for this to push up. I mean, if we close on above 180 in the early part of the week, and I was suggesting but as early as Monday, then I think the potential to do a full retracement to 190 to 200 is a good probability. Certainly no certainties in this market, but a stock like that has reacted in this way. So 1, 2, 3 waves to the upside, 4 waves pullback, 5 wave into that, almost into that 50%, and now we've got a 1, 2, 3 wave correction. So as long as we don't close underneath these lows here at 170, this is a stock that you might want to risk 1% of your capital with stops under these lows to find a way back to the 190, 200. But in all of this, monitor the Dow on a daily basis and make sure that we are continuing to hold these levels, and you need to see that pushing up inside 2 days. Otherwise, if we're not heading for 180 plus by into the latter half of Tuesday and towards the Tuesday closing to Wednesday, then be warned that if a stock like this can't push higher, then that's a bellwether signal that the market is potentially not able to stand up. Now, already in the face of all this, I've been watching some pretty nasty data come in all the time that this Goldman Sachs has been holding up. So this market, particularly the US, now there's plenty of other stocks to look at as well, not just this one. Let's have a look at Amex. Oh, that's a nasty bar. Let's not look at Amex. Let's look at something. Let's look at Visa.
Why can't you look at Amex?
Good question. It's just one of the things with this retail. I think I need to get my futures account up on this to look at the charts properly. But sometimes you get some abnormalities. It's very rare, but sometimes you get some abnormalities in these charts. This particular chart package, and that looks like an abnormality to me. I don't think.
Let me have a look on mine.
Have a look at see if you can compare what you've got on your charts to that, because that doesn't look right to me. I can't imagine that Amex would open up at 118 and plunge to 83. That doesn't make sense.
Okay, I'll just check.
It's very, like I said, it's very rare for this to.
Right. No, it didn't.
What have you got on your chart?
There's no spike on it at all. It just opened at 83.
Yeah. So I don't understand why this chart's done that. I don't understand why it's showing an abnormality like that. But next time I do this, I think I'll call up my other chart package, I think.
It just stayed at the 83.
It just stayed at 83, okay.
Around then. I mean, it was
right.
The bottom
that's why I veered off it, because it.
But ignoring that, does it look like it looks like it's?
Okay. If you, okay. So Jessica's looked at a different chart package, which is not showing this retail squirt up here. So basically, we stayed down there at 83, didn't we?
Yeah, we did.
Okay. Well, the fact we stayed down there at 83 and couldn't close above the 20-day average is not healthy, but at least we have got these chart patterns. Now, the most powerful chart patterns out there are these trend lines, which combine with support and resistance. In other words, these squeezes. If you find yourself in a triangle like that, it can often mean it's a little bit of a coiled spring. Of traders who are buying these dips, if it's bullish, that is, buying these dips, and then could potentially fly up, or equally, if it doesn't equally capitulate, close underneath this level here, and then fly down.
But the highs are getting higher and the lows are getting higher as well, aren't they?
Yeah, good point. We've got let me clear the screen and let's analyze this one. I mean, looking at these bellwethers is a really good method of detecting what the institutions are doing. Because if big stocks like Amex can hold up, then that does suggest that in the wider frame of the market that stocks are able to hold up. Yeah, so we had this in this little run here. Forget this demand shock here. Let's concentrate on this move here. We've seen some higher highs and some, in terms of opens and closes, we've seen some higher lows. So this shouldn't be here. I don't know why it is there. I'll ignore that, because that's not what actually happened. This software package is not showing the correct price action. But so again, we're in this mean average spot. So even if you take away the squeeze pattern that we potentially got, we are just sitting in the middle of this most recent range. So, but the fact we're on the 20-day average is really, really important. It's the average that sits in the middle of the Bollinger Bands. Bollinger Bands measure standard deviation. So I would, to me, that is still on the line. That is still not a good investment in my book, unless we start closing above this 83, 85, and more importantly 90. My concern is that we did have, the volume is flailing, and so I guess if some of these buyers bars are much higher than the averages that we found over here, So let's not pick on this one too much. Let's move on. But the mean average that we saw in the daily Dow, in other words, hovering, you know, it was able to come up, but not able to break that central point last week in general. And that's shown in this mediocre way in which this stock is just hanging without the commitment of closing above some key levels. Okay, let's look at something. Let's look at Disney, because there's been a lot of talk about Disney. It seems to have cropped up on my alert list a lot recently. So it's a very, very similar story. These are all Dow 30 stocks. These are all Dow components. So again, the fact that these lower levels are holding is good. But we're not, again, not able to close above the 20-day average. We did close above the 100 mark. So any stock that can close above the round number, like 100, the markets love round numbers. They absolutely love them. They treat them as you know, key support and resistance, just as much as trend lines and moving averages are key. The market does take a note of key numbers, particularly commodities, more so commodities than stocks sometimes. So we closed above 100 into the close, so, and a couple of higher closes on the daily chart. So this is definitely one that to watch out for, because if we close above this level here, I think we could come into 120, 130 in the coming months. Okay, let me just grab a sip of drink. Oh, come on. So when you are selecting stocks, I mentioned about 10, 15 minutes ago about the idea of going for quality. If you are going to invest your precious capital and preserve your precious capital, I would suggest you really do go after quality now, and avoid some of the riskier, smaller stocks. The only exception in my rule book at the moment to that is some of the smaller healthcare and biotechs, which is a market that I've been following really keenly, and things like Bristol Myers Squibb. I've been tracking this one for quite a while, trading coming in and out of this one, and you can see it's sitting up very nicely at the moment. So again, but this is a key resistance point. So at the moment I'm not in this, and because if you get a major drop, this area here is a typical place where they would choose to potentially drag it down again. So this one's run its course. This has potentially run its course unless it closes above 63. If I was in this now, and I'm not, I would simply run my stop underneath 59 here, with a target of back up to the 67 plus. But if I got stopped out, I'd walk away and leave it. In the meantime, so I've traded this one in these moves up here. These are very simple pullbacks and breakouts here. Again, I've just drawn a 5-wave move there. 1, 2, 3, 4, 5. Whoops, why's that screen gone? So in the push up in there into December last year, that was a 5-wave move. Into January, so we saw some excitement and breakouts and extensions up there. It quickly got slammed down into support. So that's a stock that I have traded in the past, and I'm currently waiting for a pullback.
Where do you think?
And other opportunities
where will it
are.
pull back to, do you think?
Say that again.
Where do you think it will pull back to?
What do I think it pulled back to? So I've just gone off it. I'll just drag it back again. I would really like to buy Bristol Myers back there about 55, 56.
Okay.
So if I actually, this just chart's untidy. I don't like untidy. Well, I've messed it up. Let's just drag that back down again. I think the main support, on just pure support and resistance again, is down there around at the 50-55 mark. So if we can topple down there in the coming weeks, and maybe it mean waiting for that one over the summer, I would set an alert on that. In fact, I'll do that now. I would set an alert on that and just wait, and just be patient. If it runs away from, if it starts to squirt up, then I would wait. For example, if it starts to fire up here and get up to 67, I would then potentially buy 62 to see if we can get back to 67 plus. In the meantime, I'm hoping that that will not see any further push to the upside and see some dips into that support.
Okay.
Yeah, I think, which part of the world are you in, Howard? But certainly overall, I mean, even in the UK, we've got some, even shops reporting Hereford. Okay, yeah, we've got shops in the UK preparing to open. In fact, we've seen some DIY stores open this weekend. We've seen some factories, including Aston Martin and car factories, already opening their doors. So, and that appears to be why these markets are holding up. So whilst the markets could be joyous and celebrating the opening of returning to work for some sectors and some parts of the economy, overall, yeah, I'm still on the lookout. I think for these resistance levels. So if I would be quite happy to see this market bounce up here in the coming weeks, into early June, maybe who knows, maybe as far as July, and then I want to put my bear raider hat on and then start to look to short and hold some shorts in a return to some of these levels here. Now I will do that sooner if we start to break down and close lower here, but in the meantime, the fact that we're not able to close, the fact we're able to hold up here, I will just back off and not start selling this market and still look for quality short to medium term until we start to breach some of these higher levels. But that's the beauty as a day trader. I would tear that plan up if these markets started to close down here in the coming days, and maybe even into as early as next week. But at the moment, the market's shrugging off bad news. Appears to be a drift back to work. Quality stocks are holding up. So it appears very short to medium term that these are markets to be bought, and there are still profits to be had. But I'm on high alert for shorts. Just go through a couple of the stocks that I'm looking at, and then we'll start to open the floor up.
I just sent a message. I just sent a message with some big ones that are reporting next week.
These are ones that are reporting. Yeah, let's look at those now.
Because I mean, Amazon.
I've got the Dow 30 up in here now anyway. So let's have a look. Facebook, yeah, Facebook is a great one. Let's find that. One of the reasons why I like Facebook is it's a great stock. It's not too expensive. Some of these at Amazon, you've got, unless you buy options, you've got a lot less leverage on it because the stock's so expensive. As Facebook is priced where you can get a lot more stocks for your bucks, then this is a good one to follow. Now that's interesting how that's gone right up in that 191 fib extension. This is an 89-day average and a 20-day average. So that one shot right up into that resistance, and stopped right on these March 4 lows. As the earnings is coming up so close to this one, I would I would, if you're in it, then just manage your risk. If you're not in it, don't worry. There's going to be plenty of opportunities to get in this one. And so if it does fire up, it will normally return back to its breakout point. Let me show you an example. This is why I never chase the market. If I'm in something that's breaking up, I just do not chase the market. I wait for pullbacks. Here's the 30th of January, it fired up. Now, whilst this didn't retrace back to its break, okay, this is a good example. If it's a really strong stock and it's not, and traders are going to hold, and investors, institutions are going to hold and not drop it back, then the only option you've got is to watch consolidation like this and start to buy higher up. So here we broke up on the 30th of January. Here we just drifted lower into 21st of Feb. So this just refused to really significantly pull back. So this here on the Friday the 22nd, it didn't engulf the Thursday sell day, the bad hair day, but it certainly did hold, and even into the following week we held up here. So there are times where you just have to pay a higher price, simple as that. And a stock that's got all this support up here at this particular point that wasn't pulling back could be one of those case in points. So what you would do in a situation like this is, it should be your job to follow, well, particularly in this market, to follow good quality stocks. Wait until you get some higher closes, and then start to bid. In other words, start to put an order out for these prices with a stop, relatively close to your entry point. Don't risk. I wouldn't put my stop all the way back there. My attitude would be if I got filled and my stop was here, I got stopped out, I would back off and then hope that it would eventually, if I was wrong, and it did eventually come back here, then I'd be very, very patient and wait for it to come back. Why? In my book, I don't want to sit there with really big stops. I don't want to sit there with holding that stock with a risk reward ratio that is 1-to-1 or 1-to-2. When I'm investing and when I'm in stocks, I want risk reward ratios that are 3-to-1. So I can achieve a higher risk reward ratio if I take a trade with a tighter stop. So that leaves me scope to sit in a trade, take some localized profits without risking that much capital. Risking that much capital rather than that much capital. So I'll do that every day of the week. I even do that on day trading. I won't go into a day trade, particularly you've got very volatile markets, and they're still relatively volatile. At times over the last couple of months, you've seen the Dow move 300, 400, 500 pips in 3 to 5 minutes. So the last thing I want to do in a Dow trade is have a 100 or even a 200 pip stop. So what I was doing, and I'm still doing at times now, is jumping into a trade with a much tighter stop, coming out if I get stopped out, and then reassessing. And that's what I do. I take that thinking on my day trading into investing. I'm not going to sit there with a big stop when there's a risk of that running right the way back and spoiling my party. Do I look at divergence? I definitely look at divergence. The reason why Howard's asked for that, for those of you not familiar with divergence, there's all sorts of ways you can look for divergence. One of the ways I look for divergence is in this oscillator. It's called an awesome oscillator. All it is, it's the histograms in a MACD. For those of you who are used to MACD, if you put a MACD next to this, it's just a more graphic version of the histograms in a MACD indicator. Now, the reason why I posted a warning in the second week of February on the DAX, and of course this applied to the Dow more so, or as much if not more so. So what you're looking for in divergence is, and this is a really good tip and something to really have on in your system, in your trade plan. If you've got a market that is making new highs, so here, you can't see that clearly. Let me drag some more data on the chart. And show that at an extreme level. This is relevant because if we see divergence coming in the next week or two, it's another big hint for the potential direction of the market. So here is new high in the market. Here is another new high in the market and another new high in the market. All the time we're making these. This made a higher high here in this indicator, and it made a lower high and lower compared with this one over here, high in this indicator, and then broke through the midline. This indicators, nearly all indicators are lagging. We already saw confirmation of a problem with the market, or the problem with the price, I should say, up here, before this indicator broke the midline. The midline's broken down here somewhere. So yeah, just look out for that divergence, and something as simple as an oscillator that's just extended is something else to watch for. Now, so if we were to see some divergence now, what would we need to look out for? Let me go back to the Dow, because the Dow is more extreme. What you'd need to look for is, we definitely got some, you can see the momentum coming off at the moment. In the coming, in the last week, this oscillator was dipping whilst this market was picking up. So there is a degree of divergence in this market already. And so that's why indicators lag. I don't sit here trading off indicators. What I do is I make a note, already been acutely aware that we're running out of momentum as we push into these resistance levels anyway. So the early part of the week, what I'm going to be doing is sitting on my hands and looking to see, as I said before, at which point that market can close, either side of the apex. In the meantime, I'm acutely aware that we have got volume and momentum coming out of that market. But it's a squeeze. So so the close above there could create a short-term rush to the upside and gap filling. If it does, these are the levels that I'd look for to take out profits. If I'm in a day trade here, and during the day we start closing above 23,920, then I'm going to hold on to that intraday and potentially hold it into 1, 2, 3 days. And what am I going to be doing? I'm going to be looking to have exits at these levels. And as a day trader, I've got an option. I've got 2 or 3 options. Or as an investor, you've got some options as well. But as a day trader, I've got even more options. As a day trader, I could hang on to that half size or full size position with a stop under these lows, or even lock in, get my stop close to break even, assuming it wasn't going to be too far close to the close. There's no point doing it if I get my stop too close. You might just as well take profits. because the only way you're going to stay in the market as volatile as this is to give it some distance. So as a day trader, if I've got a lot of profit on the books, I'm able to keep my stop away and it closed above that level there, then that could indicate that we could see a punch into 24,400 and, like I said, 25,220 up there. And as a day trader, I could add to that position. I could keep that stop down at that level, come back in, buy more with a more localized stop, and scale into that without any significant increase in risk. As an investor, if you're looking to stand back and just hold a position, you're going to need, at this stage, for that to close above 8,750. Buy a pullback, I would put your entry potentially 8,750, put your stop under 140. That was Friday's low, and see if you've got to go have a comfortable position. You've got to have a position that matches up with the scale of your account. I don't risk more than 2% of your account, and then put these sorts of targets in. And I mean, even as an investor, the risk-reward ratio would be, well, you'd need to hit 25,780 for that to be, I'm just eyeballing it now, for that to be a 3-to-1, would you? No, I think, no, I'm wrong. You could just about get 2.5, 3-to-1 on that if you took 875 and a stop under 140. Somebody do the sums for me. Anyway, that's, you know what to look for anyway. Let's start digging down into certain stocks now. Let's have a closer look at these Dow stocks more quickly, and then we can start to diversify into other areas, and I'll show you areas that I'm looking at with keen interest. Let's have a look at, let's go through the stocks that have got earnings so we get a feel for how they're reacting as they come into earnings. Now, Microsoft's been doing really well. One of the reasons why I like the stock is, forget the fact it's Microsoft, and we know it's a quality stock with a good balance sheet and cash reserves, but that's a relatively clean chart given the sort of noise we've had in the second week of February into the third week in March. That didn't get too badly disturbed because all we did was came down to key support levels. So even though that's so as Microsoft closed above here on the 23rd of March, which is a key turnaround date, I'm not in this stock. I've not traded this stock for a while, but I would have held out to buy 135 with a stop under there. You wouldn't get filled. So if you bid on a certain price and you don't get filled, then start to see how the market reacts, trying to find the next support level up. Now you may have to go smaller size on that one if you ended up buying that. This is hindsight. But as a rule of thumb, I would go a third of the way down that bar. That's a principle I have in my trade plan. I would go a third of the way down of a big buyer's bar with a stop at least 1 day back, ideally 2 days back. So you could legitimately gone into that trade at around the 140, 144 mark with a stop back down there. Anyway, the reason why I'm looking at this is to see how it's behaving in the run up to earnings. So we've had a run up into 182. We held up on Friday. If you're in the stock, you would just manage your risk. If you're not in the stock, I would back off. I'm not sure which day the earnings are for this one, but whichever way day it is, I would stand back, wait and see, wait for earnings to come out, and potentially take it in as a day trader, potentially. Otherwise, if you're an investor, back off, put it in your diary for the day of the earnings, and then buy a pullback depending on which way it comes out of that
But
that pattern. So at the
might
moment, that's a pretty interesting pattern.
the end of that,
We're
though,
close to the highs. We just need to see how that reacts on earnings. Simple as that.
the end of that, though, the last few days.
So I can't hear you at the moment. Hang on, it could be me, my fault. Could you repeat that, Jessica?
Yeah. If you just take it from, say, April the 15th. So if you just look at the chart from, say, from there, go back a bit to April the 7th.
15th. Sorry. Yeah.
I mean, or just go back to the 7th, for example. Just look at the most recent kind of few weeks.
Yeah.
Doesn't it look like a good buy at those? Because it's pulled back to
Yes.
70.
I mean, I think the overriding. I mean, any stock I'm interested in, I would simply do this: throw the fibs on it, look at how these zones were affected. So here, for example, on the 26th of March, we close above a zone here. So that's a good buy signal. If the market was able to hold that up into the close on that day and breach a key resistance level, then if you then threw on a little short-term trend line and go by the third of the bar rule, I would be looking at about that sort of price at that point. I'd be looking to get in.
If, for example, if their reporting isn't as bad as people imagine it might be, if they have a good report because they've got their, say they report reasonable numbers, when they report, that's going to shoot up. And it looks, isn't it right to say that it's just come down from a peak? I mean, it got up to 180 something, 182, did it?
Well, recently I got up to 183, 182.70.
So I mean, if it drops tomorrow to 170, wouldn't that be a good buy prospect? On it, just risk the fact that they're going to, and putting in a short stop at 160, one buy at 170 and putting in a stop at 165, for example.
You could. I would go in half size if I'm anything above 50%. Particularly with earnings volatility, I would probably take a half size position there on a pullback to.
So you buy at 170 and stop it out at 165, just in case they report good numbers or numbers that don't scare the market and it shoots.
Well, let's look at the scenario plan for this. If you try and buy a dip into that 168, you have a stop underneath the 50%, or if you get stopped behind 165 under 165, you're coming in 3-4 days back, so that's actually a pretty healthy stop, 165 alone. So I think you could legitimately, in my risk reward parameters, try and bid at 168, 170. Stop under 165.
Yeah, that's what
so you're going to be the danger is with an earnings that you get some violent moves, but this is obviously a stop line.
But you may get a violent move upwards.
But at least with something like Microsoft, in theory, it shouldn't. If it is a violent move, it shouldn't be extreme. Yeah. It normally isn't, but it could be. What do we expect the unexpected? Nobody knows how it's going to work. But just don't load. Like I say, if the higher it is, or if it's over 50%, then I personally wouldn't take more than a half-size position.
Okay.
Simply because it's already had a move, and you're later into the move, and so it's just an issue. Just something I've written into my trade plan. If the moves potentially.
Okay, but here's a question then. The really good stocks have already had good moves, but there's plenty of stuff out there which hasn't. So okay, American Express and Goldman's, yes, you're right on those two. But if you look at Amazon, for example, if you look at Facebook, we've already looked at. If you look at Microsoft, and those
Yeah, talked
companies
about
usually
Disney.
to be doing Zoom, for example. They've all had massive moves upwards.
Yeah.
Companies that are COVID proof. So
Also, one thing I've been looking at is I've got scans that allow me to look at that help me look at balance sheets and so on, and not just price earnings. I want to look at the potential, the stability of the organisation, and their analyst ratings. I take into account how analysts are rating these stocks as well. And this is one that's come up on my radar. This is Uber. Now, a case in point, you've been saying a lot of these stocks have had had decent moves.
Okay.
Have picked up. This is another one that if you come into this, the move is already we've already had a decent chunk of a move up here. But again, if I would just handle the risk differently with a stock like Uber. I would look at trying to buy into. I bid on something like 28.50 and just come in. I'd have to check their earnings date because I'm not aware of that right at this precise moment. But I would, for example, think about coming in at 28.50 with a stop under 26.50. It's not that big. It's a relatively small stop. If I'm wrong, just out for 30, 31, 35. We're going to get some swift moves on the back of pieces. That's what I want to be in. This has come on. This should have picked up on my radar earlier on, but anyway, I still would risk a certain amount. Valerie, I'm going to talk about commodities in a moment. So I'll come back to your question about uranium. What wave pattern are we in? Yeah, I think we're potentially still in a recovery pattern with the. Just answer that briefly because that's a good question. If we've had a 5 and 3 wave move, 5 and 3 wave move completed, could have potentially completed here on the. It's a Sunday bar. Could have completed on the just before Easter, April 9. Let me move that to April 9. So the 5 wave count takes you down to these lows. Oh, I didn't explain why those lows were so important, did I? I'll come back to that. So then we had a 3 wave move up here around about the 3rd of April. So the fact we were able to close higher on the 16th and we're still holding up on Friday the 24th suggests that we could still see some more upside because the selling, the bears were not able to hold us down under 22.8 and give us an impulsive first way to the downside. So at the moment we've got some fragile holding patterns. So there's 1, 2, 3, 4, 5, 1, 2, 3 into this area here. But when we did see some selling, we weren't able to complete under the 22.5. Now that would have made me very bearish. But the fact we then held up and we are still sitting almost at the 50% is why I'm hesitant to get. Well, I'm not bearish this market right now. I won't become bearish unless we either sell up here or close down here. So that's why I'm still looking to buy at the moment, looking to see if we can get sort of a unraveling of the lockdown, an impulsive reaction to take us back to these resistance levels, and then later as we get in towards the summer then potentially get short. So it's a good question, but yeah, that the price action in the second half of last week led me to believe there is some still short-term upside? Good question. Right. Quick look at some more Dow 30s, and then we'll look at some good juicy options. Let's look at Home Depot. Let's look at the retailer. It's holding up. Right on the sort of in the apex on the cusp there. So
is that a proper dip, or is that your software again?
I think I'm going to have to stop using this. This software seems to be a bit unreliable. I don't think. I suspect if I looked at my other chart package, that wouldn't be showing that. Can you just have a quick look at Home Depot and yours?
It's gone. It didn't have it didn't shoot like that at all.
Okay, that's it. I'm not going to use it. I have to ditch this software presentations like this. I don't know why it's doing that. I'll have to get back to the broker and ask why that's happening.
It did have a rise. It went from on the 22nd it was on 202, and then the 23rd it closed on 212.
Right.
So it was kind of at the bottom of that red.
Okay.
Yeah, it was at the bottom of that red bar.
Right.
But it didn't have anything like a rise like that.
Okay.
Yeah.
One of the things I won't talk about now, one of the things I have been monitoring is also a lot of talk about 5G. So keep a very, very close eye. I'll cover this on a completely separate occasion, but any organizations involved in mobile technology, from basic mast providers to phones and so on, have already, like some of the stocks we've seen, already seen a decent bounce. But with 5G in where it is at the moment, that a lot of these telecom stocks and mobile related stocks are worth keeping a check on as well. I mean, the way I see the rest of the year unfolding, I just see this split between the health of the technology and the healthcare sector versus issues that other parts of the economy are going to have to grapple with as we attempt to get back to some level of normality.
And also US versus UK and Europe.
Yeah, definitely. There's divergence between the UK and some part and DAX. I think let's have a look at compare the DAX to the FTSE. Definitely divergence between Europe and the US. So there's a lot to. I've got a different style of fibs on there, which I won't go into today. Let's just throw the fibs on the whole move and see what that's showing us. That's better than the FTSE. That's okay. So the FTSE is at the bottom of the pile. The DAX is further up, and then compared to the Dow, and the Dow is sitting on 50%. So the FTSE, I think, is on the lower level.
No, I think FTSE was on 46.
It was the same as well, was it? Okay. So the DAX and FTSE are on the same sort of average, but the Dow is one step ahead.
Yeah.
Basically, to cut a long story short. Okay, right.
But a big part of that surely is also that the big players that are pulling the Dow up are the technology and healthcare companies, and they all happen to be American.
Yeah.
I mean, like the Amazon, Netflix. Look at what is in the Dow 30.
Yeah. So at the moment the Nasdaq is leading. So you're actually seeing much higher level on the. So the Nasdaq is way above the 50%, coming into that higher significant resistance zone up there. I didn't mean to do that. So the close in the Nasdaq on Friday is much more impressive than the industrials, as you just said, as we've both been talking about in terms of healthcare and techs. So all the time, you know, you can see this huge trend line this Nasdaq is sitting on. You know, this pullback last week was ditched under the trend line, immediately closed higher on the trend line. So Wednesday, the close on Wednesday was significant for the Nasdaq and proved that the Nasdaq could have further to go. So, yeah, short to medium term, we are still, you know, as long as this Nasdaq is, like I said, where the Nasdaq goes, the rest of the market follows. So if this Nasdaq continues to hold up here, that could potentially at least drag some of the industrials up with it.
But the issue I just thought for us is that if we, you know, some of these big stocks have already done a lot of their moves upwards. I mean, the ones we've just looked at, for example, you're saying don't buy them because they're already up there. Like Microsoft, you could just about get in. Uber's already on 50%. You know, there's not a lot of pickings in that part of the market, whereas there are other stocks that are absolutely on their knees, and a kind of a move upwards would then move. So it's really that second tier, not the retailers, not the airlines, not the hotels, but that second tier of stocks that have taken a huge beating but haven't started moving their move up. Surely that's what we're looking for, or not?
You could do.
Isn't that where the great opportunities are going to go? Something that's at 25% and is likely to go up.
The danger is those stocks, just as the stocks that have been holding up that we looked at have got relative strength, those stocks that have not reacted to the indices and are underperforming the indices have got relative weakness. What I would...
I mean, for example, a stock I've been looking at is Booking.com.
Which one?
Booking.com.
Booking.com.
Which is, or Expedia, for example, the two big online hotel and travel, you know, hotel booking agencies that have been, that's it, that the Booking Holdings, that now they've been beaten because obviously nobody's booking hotels, nobody can stay in hotels, but they are a tech company. What does that chart say?
That the reason why I don't like that stock is because it's quite ragged.
Okay.
By ragged, I mean there's no. If you've got a stock that simply doesn't have clean direction, and this is sort of, you know, it's gapping up and immediately closing down. It doesn't have that continual flow to it. You can see a lot of space between the bars. That's what I'm getting at.
Okay.
So it seems to be you know, making short, sharp reactions rather than seeing institutional buying, institutional selling.
Could you put the fibs onto there and see what they're saying?
My view of this stock is it is actually holding that bottom zone. I think the way to trade that, if you wanted to trade that, is to try and bid on a low price with a close stop in a half position.
Yeah.
So that you've got half exposure with a tight stop. So if it zooms off, this could potentially be quite a volatile stock, and it could get a volatile reaction. So if you've got a half size position and you get a volatile reaction to the upside, then you're going to get the same profits.
Start flying again. Can you have a quick look at Expedia just really quickly, because it's the same. Yeah. I think there's something going on with Expedia. I can't remember what it is.
That's a lot better. That's a lot better, but still ragged.
Well, if you've gone,
that's above.
Why have you put the 100% that low and not higher? If you look at the November, wouldn't you put the 100% in November?
Oh, this is the most recent move.
Okay.
That's the most recent move. That's an older move, and that's an even older move.
Okay.
I've gone for the most recent move.
Right.
That shows a reasonable degree of health. It's got volume to confirm.
They've just borrowed some money. That's what they've done. I think they just borrowed
Right,
some money to try and support themselves.
right.
But I mean, both of those are tech companies. They're like Airbnb.
Yeah.
The reason that they're slaughtered at the moment is because nobody's able to reserve a hotel on them because there aren't any hotels open anywhere.
I think there's a bigger risk.
Yeah.
The bigger risk. So you just take a you know, if you some of it's down to personal preference.
Yeah.
I would, before make a commitment to that stock, I would look at their balance sheet and look at their the analyst ratings, see what the analysts say about this. And if you've got some big analysts that are saying Expedia are stabilizing and going to really benefit from, you know, any short-term lifting of lockdown, then, you know, I would risk some capital in line with the analysts.
My point is that, though, that those have got some way to go back up again.
So you think what you're saying is that you think there's greater potential for profit because there's greater potential to lift higher.
Yeah, because they were already so depressed compared to where they were 2 weeks
ago.
But
if you've got,
you know, and I could see that because they're an online business, they still fit within that kind of tech category almost. It's just that their market is so depressed.
But yeah, I mean that's the issue. They step across two key markets, don't they? They're a tech company. Yes, they're a tech company.
Yeah.
They rely on consumer environment.
Yes.
That is suffering from the demand shock.
Yeah.
So they're not entirely sitting in the tech camp. Therefore, in my book, they don't fit the tech criteria that I need for my portfolio.
Yeah, it's just looking at what to buy. That's what I'm.
Yeah, I get your point, but my investment attitude towards it will be go in small.
Yeah.
If you're right, you should end up with a decent sized profit because you'll get a bigger propulsion.
Yeah.
But the threat of being wrong is higher.
Okay. But then there is, sorry, I don't want to go on and on, but there is an equal threat, surely, isn't there, that some of these other stocks that haven't really had much of a hit, like Microsoft, it wasn't pushed down a great deal by the market, and that actually when lockdown finishes, or as we come out of lockdown, if there is then a big recession and if people aren't at home, so they're not using tech as much as they were, so companies like Netflix and Zoom and so on, and maybe Microsoft will all not have such the big demand patterns, maybe you'll buy at a higher point, but actually the market could really push those companies down. Maybe they will have, I mean, there was something I read that said, it does not seem that Apple and Alphabet share prices taking into account that there may be a long recession yet. Wall Street is betting that digital consumption habits forged in the crisis will extend well beyond it, making the rebound when it comes all the stronger. But Alphabet has only dropped by 18%, even though there's been a massive fall in advertising revenues from travel and tourism, for example. So there's a risk, isn't there, even at buying the really...
Yeah. Also, maybe something I haven't made clear is that I'm talking about just days and weeks.
Sure.
Fully expecting that. I think there's a massive aftershock on its way, but in the meantime, we can factor in a bit of a sort of almost a further extension of what is to me a relief rally.
Okay.
I'm seeing this as a relief rally. I'm talking
like a bear bounce almost.
Yeah.
Yeah.
And so therefore, I'm only investing in terms of days and weeks only.
Okay.
I'm not allowing myself to think any further than that at the moment.
Right.
Primarily because of the point you're making. You're making the point that, you know, these good stocks have already had a healthy bounce. So what is left in the pot for that to continue higher.
Yeah.
And you're absolutely right. They're potentially not a lot, unless the thing is with the US market is the US market is great at overreacting. The reason why the US market is so great to trade is because they always overreact. The depths in which we can 18,165. This is a short, sharp demand shock, not some incredible nuclear war. So that's why we've seen it. That's why I think there is potential for this to still lift higher. But once the lifting's done, I think we could get some equally severe dips as the sort of reality kicks in, as the ultimate ripple effect starts knocking balance sheets further down the line.
So the name of the game is really tight stops, isn't it? That's
the name of the game is risk management.
Yeah, keep your stops really close.
Absolutely, risk management. So quality stocks, but sometimes half-size positions if the risk-reward ratio is not great, and tighter stops to safeguard your risk-reward ratios.
Yeah.
So it's and ultimately look for, as Howard's pointed out, keep an eye on divergence and these indices for any indication that the overall momentum of the market has gone and the buyers are not prepared to pay some of these higher prices that we're seeing in the good stocks. So we're at a really important sort of juncture here, because with earnings season still to complete, we've got US GDP on, is it Thursday? Let's have a look. I've got it here. Be on Thursday. Yeah, we've got Fed on Wednesday. Yeah, we've got we're looking at almost -4% quarter on quarter. Excuse me. So that's a hell of, these markets could be setting up for a knock in the second half of the week. But up till now, the reason why I'm not factoring that in at the moment is because we've had some pretty sour data while this market's been pushing up. At the moment, lower data numbers have just fueled further upticks at the moment.
Yeah. Can we have a look at oil?
Yeah.
Oil companies and UK.
Yeah. I'll tell you what. Rather than switch from commodities to stocks, let me just look at a couple of other stocks first, and look at a couple of UK and a couple of other prospective US ones, and then we'll move on to commodities. So UK stocks I've been following have been BT and Barclays. I was taking a look at this. I was getting ready to buy Barclays on Friday, but it just looked horrible into the close. So I'm going to give it some more scope to see. I'm going to need that to come into.
You got BT on there?
Oh yeah, but BT's. I meant BT. Sorry. I'll look at BP as well now I mention it. But anyway, I saw the push higher on Thursday. Was getting ready to buy and left it to see how we reacted into the close. I saw such a weak close, I decided to back off. So I'm still looking for 110, 112 to see if we can come down there and hold. But again, that's I'm not that thrilled with that stock, and happy just to sit on my hands for longer, for as long as it takes until we get some decent buyers coming in. Barclays, same story. Gonna sit tight and see how we open the week.
That's not as bad though, is it? Because the lows are getting higher.
Yeah. You can see, compared with US stocks though, they're pretty pathetic, aren't they?
Yeah, but again, they've got more to go. Have you put the fibs on there? But it's right in the bottom of the doodah, bottom of the fib range.
Picture of the doodah.
Yeah, you know what I mean.
Yeah, see, we're not
We're
holding.
23. I mean, you got loads of.
Yeah, we're not holding 96, so that's a concern.
But it's a really they've got a huge balance sheet, haven't they?
Yeah, and a huge exposure.
Yeah, there was quite a lot in the press last week about Barclays saying it's a really good buy, though, and saying
Again,
well.
yeah, my attitude towards it would be to. I'm not overly concerned with the close on Friday because it was just a sort of a fairly static move. We didn't drop on the Friday at Thursday's push higher, so that's okay. I'm much more inclined I would carry the same strategy. I would go in nice and light, not heavy-handed. Keep my stop close to this recent action, and then bail out if I'm stopped out. Otherwise, I would add to some of these. If we start to, I'll take a position down here if I get certainly bid down here. If I filled and we move up here, I'm going to hold that position and add.
Is Howard saying that Barclays is reporting this week? Is that what you're saying?
No.
Speak with Howard. Speak, Howard.
Oh, reporting this week. Oh, I see. I'll obviously need to check that.
Oh.
Yes. Okay. So I need to go and check on that and look at that.
Howard, do you know when it is this? Do you know the date this week, Howard? It's probably worth.
I'll go and find that information and punch it out if Howard's not able to come back with that. That's fine. Right, let's look at.
Oh, thank you.
He's going to look. Okay, thanks.
Howard, you also mentioned other banks reporting this week? UK banks, is Lloyd's reporting this week, for example? Because that's something we could look at.
Lloyd's is holding up okay. Well, if Barclays is reporting this week, I bet Lloyd's is.
Oh, it is, yeah.
Right, let's look at. I forgot what I was going to look at now.
BP.
Yeah, BP.
So actually, Barclays and Lloyd's, if they're both reporting, it could be the same strategy as Microsoft, like go in, tight stop,
going light,
just in case the reporting as bad as people think it is.
And then if you've got something that's doing what you want it to do, what you expect it to do, then add.
Yeah, sure.
You can always complete a full size position higher up rather than go in full size. Given all the variables that we just mentioned in the last since we opened up anyway. BP. I think we need to look at oil to really measure BP.
Yeah.
I mean, it's
a mess.
I mean, considering what oil's done, that's held up pretty well, really. I think that's got relative strength to oil. The fact that we could close higher on the 22nd Wednesday and hold that bodes okay. Let's have a look at. Yeah, I mean, to play safe, you'd need that to close above 330. That will be a key. That will be a significant price level to tell me that is higher. I suspect this is probably going to come. I think it's going to come lower in short term. I think it's going to come. I would put money on that coming to see 290 again. And then if that holds 290, I'd be in if we close higher. Right, let's look at commodities, because I think commodities are really interesting. And this is where there are some potential moves to be had. I think the gas price was a knee-jerk reaction to oil. So I'm not looking at, okay, Wednesday, Thursday, Tuesday. Okay, brilliant. Thanks for that, Howard. Oil, right? Okay, so we had this pattern here in the oil. All these, every time we pushed up, they slammed it down. That's a great sell signal up there. New high, close below, immediate close below. That's very bearish. so every time I flip a chart, I need to expand that. So on the Tuesday the 7th of Jan, we closed higher than on the 16th of September and immediately closed lower. So they had a decent clue even up there that this market was in trouble. We didn't return to a third of that bar. In fact, we got so pathetic little moves up here, and then we start to fall out of the sky with the demand shock. And the next big clue was the fact that we couldn't get anywhere near that gap. That's the next big clue. Ideally, you would look to get at least 39.20 to get short, or decent push into 42. I did think that once this Russian OPEC agreement saw that punch higher, I was surprised. I thought we might see oil might price in the recovery at this point at 26.90. So the warning signs were here, and then we just capitulated, didn't we? There was on the weekly, I had 14.20 on the books for a dip if that got serious. But of course, we overshot. Very dramatic move down to 760. So where do I think it's going to happen next? Let's stop all this waffling and think about what's going to happen next.
Can you put sorry, can you put on a 4-hourly chart so it shows?
Yeah, one step ahead of me. Yeah. So there's the last 4-hourly move. Surprise, surprise. That's what I've got. That's what I've got on my fibs. So I think we might see 1970.
Really?
Yeah.
It'll be the opposite. But surely though, as we go towards the May the 21st, the same issue is going to be that there's no storage capacity in West Texas, and so therefore the futures price is going to drop again.
Could be.
I mean, there is no storage available, is there?
I hear stories about there's limited storage. I don't know. I don't have a lot. I think if you really want to be fundamental with oil, we need to gather a lot of statistics in terms of current consumption, current storage, and the position of the refineries and the rig count.
Yeah.
If you really want to be technical on oil, otherwise, bottom line is close under 1690, and this is toast.
When?
At any time in the next few days.
Okay. And where will it toast down to?
1345. 1090. And if 1090 doesn't hold, then a retest of the 770.
So you would say, if it's short, say it closed at 1500, would you then suggest short?
If it closed at anything under 1665, then I would short. I think you have to. I work on scenarios, so because markets are random, we don't know exactly where it's going to land.
Mm-hmm.
I would just, if for example, here's one scenario: we come down to 1620 because that's a big bar here from 23rd.
Okay.
So we come down and we close under that level there. If I wanted to get short, I would attempt to get short on that 1680 if it let me. Obviously, I'd offer out at 1680 because my attitude towards selling is that I need to get as high as absolute possible. If I'm going to short, I want to get as high as possible so I can constantly reduce my risk. And
but then if you were to say, for example, you put in a short at say 1600, say you got down to 1600, but you actually put in a stop at 1678, for example,
Yeah.
would you be happy
I
with
would go above 1678.
Okay.
I would really, you need, if you're going to do that, you've got to go above 1700.
Okay.
You've got to go above 17.
But because it would be all over the place.
Otherwise, because your stop's too close. That's
Yeah.
not good. Oil's, it's volatile.
Yeah.
You've got to give yourself some space.
That happened to me. My stops are too
You've got to, you know, oils can be a whippy bugger if you're not at the best of times.
Yeah.
Well, not when it's floating around little margins like this, but once it gets the wind,
yeah,
you're going to see, you know, that you're going to see a heck of a lot of volatility.
Surely that has got to, you know, there's going to be a panic to go down because people are going to think, hang on a minute, especially when we get into May next week, people are going to be thinking, oh, the date is May. Surely we've got to think about May 21st a bit more. It's not so far away, maybe. I don't want to lose any more money on oil anyway.
I said to you that those lows. I said to you the move's over.
Yeah, you were right.
Not in terms of a reverse. No, you've long since got out, haven't you, Jessica?
Yes.
Yeah.
Thank goodness, because if I'd stayed in, I'd have lost everything.
Yeah.
Yeah.
See, when you get a capitulation, you do get some bar. This is difficult because the reason why I'm hesitating because this is just such a one-off occurrence to me. Nobody expected oil to get that extreme. And the thing that's in my head with oil is that if you've got a commodity where the Russians, I said this to you before, the Russians need $44 to make a profit.
Yeah.
The shaleers need at least 20. So anything under 20 is just dead money. So I think we will just flap around. I don't think we're going to see major shocks because the shaleers are turning the taps off. Russians know damn well, all the other major producers know there's no point in pumping it out because there's nowhere to put it. So why there's the impulse and the big move that's over. Why would they shunt it all the way down there if all these guys are turning the taps off and all the big producers are holding back? I mean, that's logic. Now, you can't apply logic to the markets because markets don't use logic; they use price action. So I'm only ever talking about scenario. If, for example, there's a lot of people out there like you, Jessica, that think that it's going to really tank again. If enough people think that, then maybe it will.
Yeah.
You know, if there's enough sellers, you see what's going to happen. What's going to have to happen for that to sell? You're going to have so many people short that the market makers have got no alternative but to drag it down. But how many people are going to want to sell when it's already, you know, getting closer to these extreme levels anyway? The beauty of shorting up here for the big boys was that their risk-reward ratios were much better. All the time you're down here, your risk-reward ratios are just not as healthy.
Yeah.
And you know what? I think a lot of people are just not even, well, in terms of day traders and investors, a lot of people are just not even touching it. I don't think. I'm certainly not touching it. So I think anything for as long as oil stays under this 20, oil will just flap around and then just sit there and wait until there's some decent news on the lockdown, some decent pickup in the economy, and then it will just fire up again.
But your hunch is, you just said if it closes under 1690, it will go to 1345. So that's one to watch. Yeah.
If I were to trade it, I would want it to close under 1678. And I want to get as short as high as I possibly could. And I'd have to keep my stop out of trouble. I'd have to keep my stop at the moment, even closing down there, shorting it back at 1678. My stop would have to go, you know, above 1800, really, $18 to stay in it, to have any hope of staying in it.
Yeah.
Otherwise, you could risk a lot of money and then just get whipped out before they tanked it, if it is going to tank.
Yeah.
But my take on this is that the move's over. They'll cap. They won't go over 20 short term. They'll flap it around, and then if the lockdown does pick up, and particularly if the American one of the biggest factors in oil is the American dry season, because 70% of Americans don't have passports. They sit in their gas guzzlers and just drive up and down the country, consuming vast amounts of oil. So if the lockdown, as Trump wants, is lifted in significant levels, I think you could be surprised at how quickly that oil pops up again. Okay, we've got a lot of reserves to eat through, etc., etc.
But as a long-term investment, would it be worth?
Would it be worth buying?
Yeah. Let's hold it for a year.
Possibly, yes. Yeah, I can see that could be one of the things that's propping it up.
I mean, like an ETF, for example, where you can just buy, you know, you can buy these ETFs that peg that track the US crude price.
Yeah, I mean, again, if you want to buy, see what happens. See what happens to this price in the next 3 to 5 days. And we've got a heck of a lot of data to get through this week. We've got earnings, US GDP, Fed, ECB. It's a busy week ahead. See what happens this week with relation to these two levels.
Okay.
And if we hold this level, it might be worth a small position with a stop under these lows here in an ETF. See, ETFs are part of the factor in this.
Yes.
But ETFs played a big role in this drop because of their virtual trading rather than taking deliveries. Interesting, yeah, it's an interesting subject, and that's a fascinating move. Like I said, I had 14 pegs. Let's look at the monthly. So we're not far off the end of the month. We're down here at
God, it was 130 a barrel. Is that right?
This these longer term charts are. It didn't get over 100, did it? I don't think it got much over 100, did it? I can't remember. This, if you look at chart patterns alone, interesting just to diverge from it, to go offline, off piece a minute. Look at this chart pattern. That looked like a hell of a long squeeze up there in 14, because all these dips were bought, kept closing higher, and then you just slammed it down. So oil's been struggling for a long time.
But look at actually 2008, which is probably the closest recession that we've had.
Yeah.
And it got to a much higher low point than it's got to now.
I remember I was long gold, and my trading buddy was long oil somewhere around here.
Oops.
And there was an emergency rate cut, and oil dropped. I can't remember what the figure was now. It's something like $5 or $10 in about 10 seconds or something ridiculous. So gold spurted up, oil spurted down. So he took a big hit on the downside. I took a big clump of profit on the upside of gold. Anyway, yeah, it's hit.
the climb up out of that was much slower than the fall into
Yeah,
it. And I think that might be the case this time as well, eh?
yeah. I mean, typically markets come down 3 times faster than go up anyway. Yeah, that's a fairly standard ratio. But yeah, it's gonna, yeah, we've come down on volume, so it's gonna be a slow grind out of here when we do eventually grind out of it, come out of it. And of course,
But
what the problem is now, when the price of oil picks up, what happens? The shalers turn the taps on and chuck a lot of oil on the market.
mm-hmm.
That's what happens now.
Yeah, but if you're looking at something for, say, a 3-year, 5-year investment,
Oh yeah, for sure.
then it's probably worth buying now, isn't it?
Yes, possibly, yes. In measured ways, yes.
You know, it's kind of got to go up in that period of time, but you just can't look at that.
I never use confirmation when I talk about anything to do with the markets.
Sure.
I only talk in terms of probabilities, but if that's fib to the high and the low, look at that. That's that magic 40 again. Look at that. The gap fill is 40, which is now a fib level. So that's the monthly chart with the fibs on the whole range. So if at some stage we close above 40, we backfill and hold the gap, the first touch of the gap is going to be a sell, more than likely, because that's just the way the markets work. At some stage we'll get a rally into 40 and then they'll sell. Or at least a lot of profit taking, let's put it that way. But then later on, if we then subsequently close above 40, we should see 60 and 70. So in theory, the mean average of oil is $77 in theory, according to this chart. But
again, Mike, can you just say that last sentence again? In theory, we could.
I don't know how far back you want me to go.
Just said, in theory, we could something $77.
In theory, we could go back to $77.80.
Okay.
Yeah, I don't know how long we're going to. Nobody knows how long we're going to take to get up there. If we do.
No, but if you bought something that just tracked the WTI crude price, for example,
yeah,
and bought it today, that for say $12 or $13, the chances are that within the next 5 years that will go up by 500%.
Yeah.
The chances are, we're not saying for sure, but it certainly doesn't look like it's going to stay that low.
Mm. But I mean, short to medium term, that 42 is a gap. Gaps are big magnets. Mm-hmm. Gaps normally get filled. You can normally have some degree of security in seeing a gap fill, but we don't know how long it's going to take to do it.
Yeah.
So if you were to dip in and with a measured risk, then you're looking at potential doubling of your investment potentially.
Yeah.
Or doubling plus to get back to that gap. Okay. So it'd be, if that's interesting, coming back to, we looked at BP earlier on. So if you look at some of the big oil producers as well, let's look at a couple of the Dow oil producers. We've got Chevron. So yeah, these prices, it's interesting how the stocks have held up. Some of the big ones have not taken too big a hit considering what's just happened. Chevron and Exxon. So another way of doing this, which is potentially lower risk and lower volatility, could be coming into these. If you're bullish oil, or at least expect a pickup in oil, then some of these oil stocks are worth looking for. I haven't tracked oil stocks for a long time. Here's some. Murphy. Devon. I think some of these oil stocks could be a better option. Let's look at a couple of UK ones.
Exxon is one in the States that's got some.
Yeah, I've just looked at Exxon. Did you miss that?
Yeah.
Exxon is holding up okay at 40, under 44.
There's your wonky chart again.
Yeah, I don't know. I have to ask the broker why it's so off.
So some of those oil stocks might be good things to look at, good buys to invest.
If you are a believer in a gap fill in oil, yes. I've traded Apache in the past. APA. It's a smaller oil producer, but that's a resistance point. But my view is there's better places to put my money. That's why I'm sitting and looking at stocks in stocks I'm not looking to trade. My view is there's better places to put your money. I mean, one of the things I've been looking at very, very closely is, and I'll come on to uranium in a minute. You guys are all very patient because I've been talking. I presume you.
We haven't got lives. We're all locked down and bored.
Let's look at start off with wheat. Now, wheat had a bad hair day on Friday, but
wow, is that your chart?
I'm still interested. I'm putting this down to the dollar at the moment. Now it's beans the one I'm interested in. Beans is a bigger market by volume, I think. I'll come back to you. I don't know that for certain, but you can see how I've marked up beans with these pink areas, these hot areas. So we had crop reports on Tuesday. We had a 3-day pickup in price into a fib resistance area at $8.54. So if we come back to $8.25 and hold, I'm going to take a swing trade position in that. We've talked about this element of the indicators. Anybody pick up on what we're seeing on the indicators? Seeing divergence. Look at that divergence. On that low on the crop report day, the histogram made a higher low. That's a significant divergence. Sometimes it just means it's a pullback and not reversal, but divergence is a key part of my reversal strategy. And we came up on volume, not significant volume, but we definitely had higher volume. Anyway, I'm looking for 825. I haven't set an alert yet, but I will do now. If we hit 825 and hold, I'm going to I'm going to take a position in the futures market and add if it closes above 854. Because if we subsequently come and test 870 and close above 870, that's very, very significant. Very, very significant because of that trend line. Close above that trend line, and that could attract a lot of extra buyers into the market. Right, let's look at metals, and then I'll think about closing up because time's really getting on. Time's running away from us. No others. I was looking at sugar, but sugar's not behaving. Closing lower, so not touching it. Got to keep an eye on it, but not touching it. Orange juice. I talked about this in the early part of the virus issue. And we had a big breakup. See how these, yes, this is what potentially beans may do. So we had a big bad hair day on Friday in beans. This had a bad hair day on 18th of March. Not a very technical term, is it? Bad hair day. bad hairline on the 18th of March,
It's
started
me.
to hold on the 19th, and then broke up. That could be that if we get the same pattern in beans, I'm going to be adding all the way up on beans. Because if we then, this is
Wasn't orange used to do with vitamin C though? That everyone thought that
yeah.
vitamin C would stop you from getting
I
virus.
was suggesting that vitamin it's cyclically it's a good period to buy orange juice anyway. But because of the virus, I took the assumption that you may see a dramatic increase in consumption anyway.
And then people realised it didn't work, and that's why they
Divergence on wheat as well. Right, metals. I don't normally look at uranium. What's the ticker for uranium? Let me find it. That's where's the metal? Can't find it. Aluminium. Let's have a look at aluminium. Well, that's a good. That's something like aluminium is a good measure of potential momentum in the market. If aluminium can hold up, that bodes well for manufacturing. Well, I have one last quick look at finding uranium. I'm spelling it right, aren't I? I know uranium's on here. Okay, I'll have to give up. Can't find it at the moment. Let's look at gold, silver, and then call it a day. Traded gold last week into that 1730. I think another touch of 17, and that might take off to 1770. Yeah, I would really like to bid at 17, or lower would be nice.
So do you think it's going to come down immediately? Do you think?
I think we'll see some. I think we'll see a pullback. There's a lot of resistance up there. I think if we come back to some like 1690, 17 and hold 1700, then I think we could see some higher numbers.
The trouble is with buying into a stock like gold, though, it's so volatile. I found that you're all over the place. You know, you're looking for a number like 1692, and then you get somewhere and it doesn't hold for 30 seconds. It's sort of going all over the place.
Yeah,
it's
basically it's a very thin market. So that's why I would never intraday. I would never look at anything shorter than 15 minutes.
Okay.
Otherwise, you're just wasting your time because it's just such a thin market.
Thin market. What do you mean?
Lower volume.
Okay.
That's how my gold chart looked last week.
Very volatile though.
It is very volatile. Yeah, you can. Here last week we had saw 1705 early part of the week, and then we saw 1660.
Yeah.
So yeah, I would.
And so how do you know when you're getting a pullback? That's my.
I'll explain that on Monday, Tuesday.
Okay.
There was that low last week was a very, very specific scalper score level. A very specific scalper score level. I mean, to the pip. That was a really, really nice entry in scalper score based on the system. So
that low predicted last week. Okay.
Yeah, one of the things that's the Friday close. I mean, basic chart pattern, I would, the major, yeah, I would go by what I've just said before, 1690, 1700.
Okay.
as a potential. And let's look at the weekly a second. It is very high, isn't it? Very, very high, but it just yes, we've got 2012 resistance levels up there at 1800 and 2011 highs up there at 1925. But that's a pretty powerful move up. I just wouldn't fill my boots with it. That's all. I mean, it's same thing as I've been saying before. You just in this volatility, be careful. But if you can trade that intra-week, you can take a pullback in a 1 hour chart intra-week. Let's have a look at the 4 hour chart. Yeah, see, it's sitting. Yeah, I started buying down here on that trend line test. I didn't put an alert out because I thought I was buying a bit too high. As it happens, it worked out nicely, but it didn't give me a massive move, but it gave me some intra-week profit anyway. Tough. Buying in a strong trend when the trend is in such a high gear, it's always a riskier game, really. Silver. And then I'll think about going daily. Yeah, it's quite a different reaction to gold, isn't it? Quite a different reaction. In fact, this looks very similar to the indices, isn't it? It's almost as that's tracking indices. It's got this same sort of, the major panic, and then a 1, 2, 3 wave upside. We started to have a down wave and then held up, so it's fairly neutral no man's land at the moment. It's as if we're looking at the Dow. That's so similar to the Dow. That's because it's an industrial metal, as opposed to a currency like gold. I call it a currency, but it's not got anywhere. Well, it's got a fraction of the industrial use. Whereas silver is used in tech and surgical instruments, of course, because of its antibacterial qualities. Did you know silver had antibacterial qualities?
Yes.
Good, okay. Right, any other questions? Let me just have a quick, have I missed anything? Gas has...
There's one little stock, it's just a quick one.
Go on.
Which is called Beyond Meat.
Oh, yes.
They went up 30% last week. I discovered this after they'd done it, but the story of Beyond Meat is they make kind of vegan.
Yeah, it floated.
They've done a big deal with Starbucks.
Oh, is that what's done?
They're reopening all of their cafes, and they're going to put Beyond Meat products in all of them. And Beyond Meat has raised money on the stock market without having to borrow. So the big story was, here's a stock that's raising money without having to borrow anything. It's about the only one that's out there.
I remember this firing up when it first floated.
It's on a lot of watch lists, and I just wondered, is it too late to buy now? Do you think it will have it will
pricing in a subsequent profit stream from that big contract, isn't it?
I'm just wondering if it's up and if it's worth buying still, or if it's just something that's.
If I were to get a lead, ideally 93, 95. I would bid. I'd hold my bid out for 2 or 3 days. So I would offer out at 95, stop under 84, And if I wasn't filled in the next 2-3 days, I consider just backing off and leaving it.
It'd be a nice one to have got in on earlier on a couple of weeks ago.
It would, but yeah.
60 to 108.
I mean, you saw there was a buy signal down there on 19th of March. New low, immediate close above on the 19th of March. You can scan for that. So the perfect, okay, we've got hindsight, but there was a buy signal. There was a good technical buy signal down there at 54. Anyway, yeah, it's you know, it's got momentum, it's got volume.
But it's too high at the moment to touch.
But yeah, my strategy would be to bid at 95, stop on at 84, leave it 2-3 days. If not filled, then back off.
Okay.
Colloidal silver, colloidal MACD on silver. Okay, I'll just quickly go back to silver. What do you mean by that, Ken? Sorry, I'm confused. Okay, you just point to the MACD on silver. Okay, well, I've got a. Let's put the MACD on then. I would say the same as with indices. You know, it's got to, if that's going to continue, it will close above 1550. Who knows? Maybe power up. Otherwise, yeah, we can't get over that. It's in that same little apex as the indices. It's holding up. It's all the time it's holding up. Could go further. MACD on gold. Okay, okay. Right, okay, I get it. Ken's talking about, I think he's talking about this lower high in the histograms here. The awesome indicator is still holding up, but the we're very divergent up here, making a lower high in the MACD histograms. You can certainly see that's a tough nut to crack up there for gold. We'll keep an eye on it. We'll come back to that on Wednesday. Hey, listen, thanks for all your input, everybody. That was great. Covered quite a lot of ground. I think what I'm going to do on Wednesday is look at the indices a lot quicker, and then I think just look at indices quicker, metals quicker, and then go straight into a selection of stocks. I think that's the pattern I'll talk about on Wednesday. We'll look at day trading as well quickly in the first part of the session, and then devote the second part of the session to a short list of UK and US stocks. Yeah, I will get back to you, Ken. I'm really, really sorry. That's worrying that I've missed so many emails. But I'll drop you a line about that. Hopefully my emails are sorted out now. 10? Oh, bloody hell. All right, okay. Right. Thank you very much for your company, guys. But I'm going to rest my voice, think about tomorrow, make a few notes based on what we've talked about, and enjoy what's left of your evening. See you later on. Thanks, everybody.
Thank you. Bye.
Bye for now.